Hello guys, good morning. Are we relatively complete? Let me have a quick look. I see a ton of people on YouTube. I see a ton of people in Zoom. I assume everything works. Can you just, if you're on Zoom, can you just unmute yourself and tell me if you can hear me all right? Yes, no? Can you hear me? Oh. Sorry guys, I'm a bit still asleep. I was mute on Zoom. Good morning. Can you tell me before we hop into it, can you hear me all right? Can you see me all right? If you're on Zoom, please unmute yourself. Let me know. Yeah? Guys, you need to unmute yourself and tell me. I'm not looking at this. Super. All right, guys. Very nice. Officially good morning then. Welcome to Corporate Finance. Let's start with a couple of logistical things first. Let's start with a brief introduction. I have not officially met you. My name is Florian. That's my name, Florian Madertoner. I'm from the glorious Corporate Finance department. I obviously teach the second year course Corporate Finance, IBA and BA. I supervise bachelor thesis, I supervise bachelor internship reports, I supervise in our own master, in the Master of Finance and Investment, every year about 40 master theses. I teach a ton of executive education, so customized programs for executives already working in finance. Everything project finance, accounting, I mean, you name it. I teach a lot in the Executive Master Corporate Communication. I teach research methods there, and I teach an elective on stakeholder management. What else is important? Yeah, I do also research. I do research on capital structure theory, so that's coincidentally also what this course is largely about. I'm not running the show completely by myself. I teach the lectures, so you will see me twice a week. I'm supported by my colleague Celine. I'm sure you remember her from the first year course. So she will again be your guide through the workshops. So I'm also not today gonna address the practicing structure on Connect. That is really Celine's show, and she will explain everything to you in the first workshop. I'm also supported, I'm super happy about this, I'm supported by Charlotte, who was last year the board woman of SR. And she helps me doing all the logistics behind the scenes. So all the YouTube maintenance, the Zoom maintenance, all of this. First of all, because I really need support. And secondly, because she, of course, sees the world through the student perspective. So I'm hoping that she will make all kinds of good suggestions that will increase the user friendliness of our Canvas, of our YouTube, everything. What else is relevant? Yeah, a little bit about the course maybe. So on Friday, it was still not clear if I will get a Zoom license for more than 1,000 people. Eventually I didn't. So we have to basically follow the structure that I already used last year in corporate finance. I think in your first year finance course, you had a similar structure. And what I've heard, you could deal with it quite well. So we thought, okay, let's just do it again. Try to tweak it here and there, improve it a little bit. But essentially, it's the same structure. You will have 2 lectures a week with me, 1 workshop a week with my colleague Celine. In the lectures, we are not going to split between IBA and BA. In the workshops, however, we do. So that means the IBA workshops will be taught in English. The BA workshops will be taught in Dutch. We are actually quite happy about this because in finance, I mean, talking about finance in any other language but English doesn't really make all that much sense, I think, because all the terminology that is used in the real world is really in English. So it would be kind of weird to refer to equity as eigen vermogen. I think nobody really does that. Celine also always prepares almost like a vocabulary sheet with the most important English terms translated into Dutch if you struggle a little bit with English. What else is important? Yeah, I have created, not I, my girlfriend has created a Twitter account. I think I have it here as well. So you can tweet at me if you like. The idea is not that you tweet at me, hey dude, where can I find something in the course manual? But if you stumble over an article that you find interesting, that you maybe don't understand, where you say it seems interesting but I need a little bit more explanation, a little bit more background. Anything intriguing, of course, if there are funny finance related memes, anything, feel free to tweet at me. I have the app on my phone, so I will check it. I will address it either by tweeting back, or if it's really a big topic, then I will just bring it to the class and we talk about it in class. What else is relevant? Yeah, course manual. One or two students already asked if there is a course manual. Yeah, yes, of course there is a course manual. We have not uploaded it yet because on Friday I was still discussing logistics with program management. Celine will make all of that available on our Canvas course somewhere today. So you will see then in great detail which chapters. Largely speaking, the course is gonna, I would say it's a little bit a mix. The first part of the course, roughly the first half, is really gonna be about capital structure. So after today's accounting refresher, when we have everything on the smartboard, I can really show you exactly which questions we are gonna address roughly in the first half of the course. So it's basically one topic where we slowly build up. In the second part of the course, we do then selected topics. So we will look into options, basically how to trade options, option trading strategies, mostly of course how to use options to reduce your risk exposure. We have a section on working capital management, so basically liquidity management. Yeah, all kinds of details that we will explore in the course. Seeing how this is a university course, I'm sure you need to know something about the exam. So there will be an exam in the end. It's one exam, there are no in-betweens, nothing, there's one exam, counting for 100% of your final grade. The exam consists of two parts. One part is essentially a calculation part. So if you picture multiple choice calculations, this is pretty much what it's gonna be. However, Celine and me are very happy about this. We were able to change from officially multiple choice to technically open questions. So the questions are really phrased like you would expect from a multiple choice question. However, we don't give you answer options, but a text box where you simply type in your numerical result. That seems basically to be exactly the same kind of thing as a multiple choice exam, but there's a very big technical difference. On a multiple choice exam, we have to, based on our exam regulations, deduct a relatively brutal guessing factor. Because of course, when you have 4 answer options, you have a 25% probability to guess correctly, which even if you do well on the exam, it's really brutal. So we wanted to get rid of this. That means the first part of the exam, calculations, like Celine will practice with you in the workshops. And like you can find them then later on Connect as well. So you can really practice this to perfection. No guessing factor because technically it's not going to be multiple choice. The second part of the exam will be essentially dealing with theory and economic intuition. The exam is going to be open book. I don't want to give this up anymore, simply because I find the exams are more lifelike. In the real world, you can also look up whatever you want. You can Google whatever you want. Obviously, that also has implications for the questions I will ask you on the exam. So I'm not going to ask you stuff that you can just, Google. I usually, or Celine and me usually go for the following difficulty level. We want 25% of the questions to be what we classify as easy. We want 50% of the questions to be sort of medium average, and 25% of the questions we want to be rather challenging. And that usually works. So our grade distributions are really showing who is doing the minimum, who is doing okay, and who is really performing at the right tail of our grade distribution. So that will work, I think, quite well. I have also, I don't know if you want that, to be honest, I got a bit carried away. There are two things that happen in class quite frequently. So very often when I talk about something, students want to know, is this exam relevant or not? So when I talk about something that's super exam relevant, I mean, officially everything we discuss in the course is of course exam relevant, but some things even more so, where just when I talk about it, I can already see myself coming up with an exam question. If we talk about anything exam related where I feel like this will be on your exam in one way or another, I've created this here. So just to basically get your attention, yes, you don't need to ask, is this exam relevant or not? If you see this, it certainly is. And the second situation that occurs frequently is that students, usually very interested students ask questions that go well beyond our curriculum. I don't know if you have seen the Twitter account already. A student tweeted a question about what's the difference in the payoff profile of a long call option that you sell before expiration versus a warrant that you sell before expiration. Now that's obviously an interesting question and I love to talk about it, not today, don't worry, but in our option lecture I would love to dive into this. So that's clearly interesting, clearly not only interesting for one student, but probably for all students that are interested in trading. However, if you're a student who says, well, I'm not all about finance, I have to do this course, I want to do well, but I don't want to become a finance person, so do I need to basically know these details for the exam? So I have created another thing to signal very strongly, I want to address a question in class. However, if you're not totally into finance, I mean, feel free to zone out for a couple of minutes or get a coffee or go pee quickly, just to distinguish a little bit. What's also important, I'm almost at the end of the logistics and housekeeping. What's also important, I've tried to build a setup that is as flexible as possible. So you basically need to just tell me what works for you, what does not work for you. I'm always happy about feedback. You have my phone number in the course manual, so you can easily WhatsApp me. That's not only okay, that is really appreciated, because again, you see probably a lecture very differently than I see it. So I'm really grateful if you provide feedback of any sorts. Don't want to say good or bad, but you know, good feedback and constructive feedback, maybe I should say. Then please don't be shy. That really helps, and it's not just a formality that I say this. I'm really eager to improve what we have going on. Last but not least, I'm super happy that the creating of our WhatsApp groups worked so well, even though it was weekend. Again, apologies for bothering you on the weekend with this. However, the WhatsApp groups are full, and a couple of students said, well, can we not have more WhatsApp groups? So yeah, officially we can have as many WhatsApp groups as we want, but it is not really something I would like. I wanted initially WhatsApp, so simply that we have a direct connection to each other. If I need something, if I want to inform you about something, I don't want to always go through Canvas. That's so bureaucratic and so often does not work properly. So I just like this immediate way of being able to talk to each other. Marco pointed out in one of the WhatsApp groups that we could have a Discord. So I looked briefly into this. I have not set it up, but this is what I would like to do, so that we really have one group that we can all access equally easily, and where we can just exchange whatever is going on. If there are questions, if there are any pieces of input, requests, feedback, I mean, whatever. So exactly like we would use a WhatsApp group. Guys, this is it from my perspective for starters. Do you feel like I have addressed... Oh no, sorry, there's one more thing. I have 4 monitors in front of me. They all show different things, but I cannot have another monitor that shows me the YouTube chat. So I would very much like a student that is following on Zoom, a volunteer obviously, to keep a little bit an eye on the YouTube chat. If there are questions in the YouTube chat, please unmute yourself and simply interrupt. Hey Flo, there's a question in the YouTube chat. The question is blah, 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 and immediately bring it to the floor that I can address it. Does somebody feel willing and able to do this from the Zoom students? Don't be shy. I'm really dependent on you in this. Yeah, Superman. Thank you very much. I mean, you don't need to stare at it, you know, all the time, but I would really appreciate it if there's the occasional question and you can forward. Super. Have I addressed everything that at the beginning of such a course is relevant for you? Am I missing something? Are there any questions? What is relevant, guys?
Yeah, I had a quick question.
Shoot.
This will be stated in the course manual, but will the workshops be taught online or in person?
Yeah, Excellent question. Everything will be taught online for all kinds of different reasons. So first of all, believe it or not, it is impossible right now to find rooms on campus, physical rooms, big enough for such a course, IBA or BA, even if we were to split. So that's already a reason in itself to do it online. Secondly, students really like the course, not just the course content, but the course structure last year. So initially, both Celine as well as me were worried that it will be very unpersonal, that we don't get to see our students anymore, that we don't get to interact, and that's the reason why both of us are teachers. So we were really worried about it, and it turned out very quickly it's way more personal than it was on campus, because I would have to teach you in the aula, there is no other room. And even if you're sitting in the first row, you are something like 8 meters away from me. You cannot even see my eyes properly. I mean, and I cannot see you at all because I'm blinded by the spotlight. So we decided the students really liked it. There are no rooms available anyway. And it is possible, I think, to run an online course in a very personal and meaningful way. I mean, everything will be online. What I want to really state on the record is the following thing. So it is not, we did not choose YouTube to extricate ourselves from student interaction. So I don't want that you even for a second think the fact that I'm now teaching you from our home in Feyenoord means that I don't want to mingle with you or anything. I live in Rotterdam, I live in Feyenoord. So I would be very happy if let's say in the middle of the course, we grab beers on campus, meet up really in the real world. That would of course be, in my view, amazing. I can assure you all lectures are recorded, all workshops are recorded, so we both live stream to YouTube. The moment a live stream ends, the YouTube servers are busy processing them, and it sometimes takes only 10 minutes, sometimes it takes a couple of hours, but the video will, after the live stream has ended, will be converted automatically into a normal clip that you can watch as often as you like. So everything will be recorded, and I'm also making a safety recording within the Zoom cloud, so you will not miss any content. I realize you have asked if there will be any classes on campus. No, there will not be any classes on campus. Everything is online. What else is relevant, guys? Is there anything I'm missing? Is there anything at this point that you need to make you sleep a little bit better, to be less nervous maybe about the course? Anything I'm missing?
Wondering about the book, if it's the same as last year. And I also have a question about Connect, if we can still use our license or login information from last year.
Yes.
Still valid.
Yeah. Okay, so question number 1, what is the book? Will it be the same as last year? Yes. Specifically, we have decided to keep the course, first year course finance and the second year course finance aligned in such a way that we can use the same book, simply because it's otherwise inefficient for you to buy a book just to discuss a couple of chapters. I think the book is not flawless, but no finance book or no textbook really is flawless. I think it's a pretty good book. And corporate finance has not been reinvented lately, so everything in there is still equally valid. Even not a problem if you would work with an older edition. If you can get it somewhere second hand and it's a 3rd edition, still fine. Concerning the Connect code, I cannot really speak to that. That is really Celine's construction site. As I've said in the first workshop, she will provide some guidance on Connect, which codes work, she knows that, and she's in touch with the publisher to address exactly these questions, okay? Guys, anything else you need from me at this point? Any questions? Anything goes.
Yeah.
Shoot.
Question. All the lectures are live. We don't have pre-recorded clips, yeah?
That is correct. Yes. Yeah. Everything will be live. And the main reason for that is I want it as personal as possible. I'm not funny by myself. I also think I'm not very interesting by myself. I tried in the past every now and then to record videos, and it's just terrible. I just hate it. I don't know, I guess I'm just more for live sessions. And the reason why I'm a teacher is because I like the live interaction with students and getting live questions and not producing basically, pre-recorded clips. So everything will indeed be live, workshops and lectures, yes. I have a last thing, maybe that's also relevant. I'm I like to think I'm rather flexible. So if there are topics, that go well beyond our curriculum, where you're very interested, I don't mind at all scheduling some extra session for especially interested students. Or if there are a group of students that say, I'm so insecure, I need a little bit more, I need maybe a bit of an extra repetition, something like this, I'm always happy to schedule something outside of our schedule. I mean, I'm now in our study room. I can fire up the studio in a couple of minutes, really. So that is also an option. So please keep it in the back of your head. If there are trouble, if there are problems, if you're struggling with something, you just need to let me know and we can think together about some meaningful way to address it. I have another question. We don't need to talk about it much. In the past, I had always in corporate finance quite a lot of pre-master students, something like 100 plus. If there are pre-master students in the whole course, what I would very much like a separate pre-master WhatsApp group. That's definitely working on WhatsApp because there are never too many pre-master students. The reason why I would like this is pre-master students come from all kinds of different backgrounds, have not followed the first year finance course, have not followed the first year accounting course, and as such it's possible that we need to do a little bit of extra sort of tutoring. So if you are pre-master students, please get organized, add me to a WhatsApp group and we take the conversation from there, how we can get you up to speed so that you can follow the course with minimum problems. Is there anything else, guys, I can do for you at this point? Any questions, any comments, anything that you need to know?
Yeah, I have one question.
Shoot.
So I found it from my own experience that the last year's finance course wasn't really effective for me, mostly because of its structure of the workshop, because it was just a Zoom meeting with everyone in the Zoom meeting, and it wasn't really addressing the individuals, practicing time. So I don't know if it's possible to, for example, have more breakout rooms that can address more, individual problems during the workshop, because I still have insecurity from the finance course because of that.
Well, I cannot really speak to how other people run their courses, so I don't really want to comment too much. The workshops are Celine's construction site. Celine is very, very similar in her teaching mindset to me, and she's just like me, always trying to improve the way she conducts the workshops. And I would simply suggest to have that conversation with her. Maybe just to clarify a little bit, workshop is not necessarily practicing time, right? The idea of a workshop is to take certain theories and apply them, and that you get in a way guided through relatively complex applications. Practicing is something that you have to do by yourself. That is not possible other way. But again, I suggest that you, not you per se, but your student representative, once you have a student representative, approaches Celine and just discusses that. All right?
Okay, yeah, thank you.
Guys, shall we hop in? Shall we do some content, or are there some more questions you need me to address before we dive in?
Just one question.
Shoot.
Are the PowerPoints going to be online before lectures?
Yeah, good question. So typically, I upload PowerPoint slides after class. It has been explained to me now a few times that students don't really like this because many students like to take notes on the PowerPoints themselves. So there's in principle no problem. I can certainly do this. I'm basically open to it. The reason why I don't do it by default is I find PowerPoints very often distracting, and I try to use as little PowerPoint as possible. I'm not saying I don't have PowerPoints. I have the most elaborate PowerPoint slides that you have seen, and I color code all the variables. You've seen Celine, of course, do the same thing. So I have always prepared everything that I sketch out on the smartboard, everything that we develop together, I have mapped out in the neatest way possible on the slides. And the reason why I don't make them available before class is simply I want that your attention is really with me, with the explanation, and afterwards I make them available. So if that's something that you would like, I'm happy to make them available before. But again, I want that you understand I'm not Teaching is not clicking through PowerPoint slides in my view. So I can make them available before class, sure. Also, don't panic when there are no PowerPoint slides. There are a couple of chapters where I specifically don't use, like today, there will be no PowerPoints today. We develop everything together on the smartboard. So if that's something that more of you want, I'm happy to make the slides available before. Yeah. And you will always find them, of course, on Canvas. So in the course of today, we will create the whole Canvas structure where then everything is neatly visible. All right? Nice.
Yeah, that's fine, yes.
Super. Shall we hop in, guys? Shall we do some stuff? I take it as a yes. Okay. Boom. On our agenda, guys, today. On our agenda today is, like I said in the Zoom link, an accounting refresher, first year accounting. Now, I know many of you are not struggling with accounting at all, but every year I also notice, not only with students, but with finance professionals, that there are plenty of misunderstandings in accounting and we need to sort this out. I don't need you to be, experts on ultra details of accounting, really not at all, but I need you to understand the core mechanic, the interaction between income statement, balance sheet, cash flow statement. So on my agenda today is going through the statements, and I really want that you're very honest with me. If there are questions, if there's something you don't understand, then please speak up. I mean, if you're embarrassed, first of all, you don't need to be embarrassed, but even if you were, then make yourself a relatively anonymous YouTube account and post a question in the chat. The reason why I stressed in my introduction that I teach a lot of executive education also serves another purpose. So I don't only teach second year bachelor students. So I don't want that you think, of course, every teacher says my content is relevant. So of course he says that too. The moment I'm not with you, I'm teaching executives that work in finance for 10, whatever, 15, 20 years. And I see the same problems essentially pop up as you would experience. And when I teach executives, I always give a pre-course assignment that they have to do before we meet for the first time. And it's always the same assignment. Write down everything I always wanted to know about accounting and finance, but was too embarrassed to ask. And that are the most meaningful questions. So you don't have to be embarrassed. You certainly don't have to be shy. I have all the patience in the world with students, especially with sophisticated content. Okay, so today is really, when we talk about accounting, today is really the time to speak up. If something is unclear, I want to know, and I will address it until it's basically clear. And the reason why we need this is accounting is the input that we use for finance. So if you're struggling with accounting, then finance is gonna be really, really a pain in the ass. Sorry for saying it like this. The second session this week, we will do a first year finance refresher. So I don't know exactly how you experienced the first year finance course, if every detail was clear, but I have for our second session this week, essentially 3 objectives. I want to go with you through discounting compounding. Why? Because we need to be, I don't want to say masters of, but we need to be proficient in net present value calculations. Secondly, I want to guide you again through the WACC. And thirdly, I want to guide you again through the capital asset pricing model, the CAPM. I'm perfectly aware you have heard all of this before. Again, I want to make sure that you are not distracted, confused by weird mathematic details. It's possible to explain all these things in a neat, understandable and clear way using not finance language, but actual human language. All right. So this is on the agenda for this week. From next week on, we will do, of course, new content. Let's hop in. I want to talk today about the 3 I only talk about 3, even though there are 4. I only want to talk about balance sheet, income statement, cash flow statement today. What are they? I want to point out a couple of specific interesting aspects, interesting positions, and especially, and that's really relevant for the real world, how they are connected. I meet very often people that say, I really understand balance sheets totally A-okay, but I don't really understand an income statement. And that is not possible. They make sense together or not at all. It is not possible to say I understand this part but not this. It is one thing that works together. And that's what I mean with the mechanic. How they interact, how they are connected, how they influence each other. Let's hop into the balance sheet. Oh, a last thing. I've got myself this bad boy here, a smart board. Sometimes students, I noticed on campus, when we were still on campus, students in the smoking break, or in the coffee break, sorry, going and taking pictures of what I've scribbled on the blackboard. That is not necessary at all. If you are interested in what I'm sketching out here, after class this is automatically saved as a PDF. So it is available. It's not very complicated for me to just slap this on canvas as well. I don't think it's necessary because everything I sketch out here, I have in a nicer way on PowerPoints. I'm just saying, should you want that, it's here, all right? Let's talk about the balance sheet first. Obviously, you know how to recognize a balance sheet. Balance sheets have two sides: assets, liabilities, and owner's equity. What is important here, that you already know what is basically visible here. What does the left side really show and what does the right side really show? So the left side is referred to as the asset side, and asset is simply a complicated sounding finance term for all the stuff that belongs to a company. Land, building, production machinery, inventory, cash, all of these things. And on the right side of the balance sheet, the whole right side is referred to as the capital side. You can see how a firm paid for all their assets. So in a way you could say on the left side you see how the funds that the company has available, how they are used or in which form they exist in the company. Do the funds exist in the form of cash? Do the funds exist in the form of production machinery, land, building, in what form? And on the right side you see where did the funds come from. Again, feel free to interrupt me at any point. If you're on Zoom, simply unmute yourself. If you have a question or comment, unmute yourself, shoot. And if there are questions, if you see a question in the YouTube chat where you feel like that's relevant, again, unmute yourself, please point it out to me and I will address. Let's talk about assets. A very common mistake I see, not only with bachelor students, but with practitioners, with people working in finance, is getting confused by very specific line items. I'm struggling, what is exactly this position about? That is not, I think, the best approach to a balance sheet. I would always recommend this. Look at it very much top down. I show you what I mean. So assets, of course, we have a bunch of very specific asset line items, but they belong to certain categories, of course. So we always distinguish between at least two different categories. The so-called current assets and the non-current assets, also known as fixed assets. I would like to start talking about current assets first. Maybe you should tell me, what does it mean in finance when somebody says the word current? That is something that you will hear in finance in this course very often. What does current in finance mean? Help me out. Any ideas? Unmute yourself, shout at me.
I think it means that the term itself changes, for example, within a year. So inventory you sell within 1 year, so it changes throughout the year. That's why it's current. So it's not long-term fixed.
Excellent. Very nice explanation, Dylan. That's exactly how it is. So current assets are assets that stay in the firm typically for less than a year. Less than a year. So whenever you hear somebody in finance talk about anything current, not just current assets, but just the word current itself refers to something less than a year. Current, less than 1 year. So if I say assets that stay in the company for less long than a year, what do they do after 1 year? They are not simply disappearing. So where do they go? The implication here is they will be converted into cash. And that's of course just complicated finance, blah blah, for they are sold. So current assets are assets that are not designed to stay in the company for more than a year. They stay for less long than a year. Why? Because they will be converted into cash within 1 year or less. There are 3 current assets that I would like you to be familiar with. 3 of them. I would like that you know cash and cash equivalents. I would like that you know accounts receivable. And I would very much appreciate it if you remembered the inventory. Let's very quickly talk about this. So cash is literally our benchmark. It does not get more liquid than cash. Cash is already cash. It's of course not converted into anything else anymore. Obviously, that is a current asset. What are account receivables? Account receivables are simply money that somebody owes to the firm, to us. Take an educated guess, who most likely owes money to our firm? Which kind of group is that most likely?
Customers.
Yeah, exactly. Most likely customers. So account receivable simply means somebody owes money to us, most likely customers. So we expect them to pay within 1 year or less. How do I know that account receivables will be paid within 1 year or less? Any idea? It's a bit more advanced accounting, but still, does anybody know? If they were due in a period of more than a year, they would not be referred to as accounts receivables. They would most likely be referred to as notes receivables. All right? But it's not super relevant for our course. And last but not least, inventory. Inventory, this is, I don't want to have now the pop-up exam, but this is real life relevant. I meet a lot of people that don't really know what inventory is. Not only students, just really people working in the industry. There seem to be some misunderstandings. So I encounter frequently people that think like when a company owns cars, it is always an inventory, or a company that owns office furniture, the office furniture is always inventory. That is not the case at all. So my question would be, can anybody of you, maybe on the spot, come up with a neat small definition what inventory really is? What does it mean when we talk about inventory? What is it really?
Is it everything the company owns to being able to do its business?
Yeah, Kuhn, I like what you say. You're certainly not wrong, but your definition is so broad that it would also encompass the fixed assets. So, for example, land and building. So you're not wrong, but it's not accurate enough yet either. I would say it like this. It's an argument that goes through a couple of steps. None of this is complicated. Every company exists for a reason. I mean, casually we could say making money, sure, but I mean, there's an operating activity. The point why a firm was established. So what's the point of Albert Heijn? I mean, Albert Heijn is a supermarket. What do? They earn revenue by selling the milk, the meat, the bread. We are RSM, we are a university. How do we earn revenue? By providing the service of education. Whatever, Ford is a car company. What's their operating activity? They exist to produce, to manufacture and sell cars, and that is how they generate revenue. So what is inventory? Inventory is basically all the stuff that the company either has or produces that they sell, and now, important, that they sell in the course of their normal operating activity, so in order to generate revenue. I give you an example. So it is possible, imagine this, imagine I'm a store manager at Albert Heijn, and at some point the management says, this guy is such a good store manager, he will get a company car. And I get a company car. I'm a terrible driver, I normally don't drive, that's really what my girlfriend does. So if I were to drive a car, the value of the car would, go down in no time. So probably 1 year after me driving a car, the car is ready to be sold and I probably need a new car. So Albert Heijn then would say, okay, hey Flo, you basically wrecked the car, it's time for a new company car. However, the old car is not completely trashed yet. Let's put it on Marktplatz and sell it. So then Albert Heijn sells an asset that they own, the company car. Would the car in this instance then be inventory? What do you think, guys? Let me know. Is this inventory, yes or no?
No.
Yeah? Why not? Absolutely correct. That's the whole point I'm trying to make. Selling cars is something that can, of course, occur in any company, even in a supermarket. But selling cars is not the main reason why Albert Heijn exists. To use official accounting or finance terminology, selling cars is not the operating activity of a supermarket. And therefore, the car would not be inventory, and selling the car would not generate revenue. It would just be some other income. Okay, so it's much more meaningful to think about inventory not in terms of cars or computers or furniture. What is inventory? It's the stuff that the company produces or sells, typically in less than 1 year, in order to generate revenue. Why would they do this? Because that's their operating activity. And there are some cases where inventory can be both. A car could be both. It could be both a current asset, inventory, but it could also be a fixed asset. Think about the car company Ford. Now Ford sells cars, so their inventory is not like with Albert Heijn, the milk, the meat, the bread, but their inventory is cars. However, I'm sure many employees of Ford also drive company cars, which are not sold. So you would find probably in the balance sheet of Ford cars in the current assets, in the category current assets as inventory, and you probably find cars in the category fixed assets, company cars. Okay, so distinguish between basically the use of an asset. Okay, so that are the 3 most important current assets. All right, let's talk about fixed assets. Guys, sorry, I need to look at my phone because I'm often forgetting about the time and I don't want to bring you, I don't want to skip the break. I suggest that we finish the fixed assets and then we have a quick break, 10 minutes. All right, so what are fixed assets? This is very easy. There's a sort of negative definition that we can apply here. A current asset is any asset that is converted into cash within 1 year or less. What's a fixed asset? Well, everything else basically. So stuff that stays in the firm for more than 1 year. Brief disclaimer here, you can also encounter in the real world situations where the case is not as clear as I make it sound now. I always give the same example. A couple of years ago, I thought I had a midlife crisis. So like everybody who thinks they have a midlife crisis, I was thinking I probably should get a motorcycle. And I really went to Harley Davidson Rotterdam. And I looked at the motorcycles there and I noticed they had motorcycles in their showroom, which is of course the inventory of Harley Davidson, and some of them were significantly older than a year, like models that were 2 years old. Can I then say this is the inventory of Harley Davidson? Well, yeah, technically it is still inventory, but I would then really, in my financial statement analysis, have to consider this, that it is inventory that clearly turns over at a very slow rate. And what I mean with turning over at a slow rate is, I simply mean that selling them clearly takes significantly longer than 1 year. In ratio analysis that has an impact. Just to freshen up your memory, one of the most important things we calculate is of course the current ratio. The current ratio is calculated as current assets divided by current liabilities. And it tells us if a company can pay its short-term liabilities, current liabilities, on time. How would the company pay for their current liabilities? By utilizing their current assets. So the assumption is, let me show you. The assumption is, I have a bunch of outstanding liabilities. They are current. That means our firm needs to pay them within 1 year. Now, which money do I have available to pay for them? Well, the current assets, because conveniently enough, all of these will be converted into cash within 1 year or less. So that means I can utilize my current assets to pay for my current liabilities. However, the assumption that is built into this formula is, of course, that all current assets are truly current. So if I were to calculate, to stick with my example, the current ratio of Harley Davidson, I would then deduct here the parts of the inventory that are older than 1 year, because clearly the assumption that the inventory is sold within 1 year or less is here violated. It's clearly not in place. Okay, so that's why it's extremely important in finance to distinguish not specifically between line items, but between the broad categories. This is short term, this is long term, and that has impact on our financial planning. That's why I'm so obsessive about it. Moving back to the fixed assets. Fixed assets are all the assets that stay in the company for more than 1 year. Land, building, production machines. In the case of a university, the campus buildings, office furniture, the chairs, the tables, IT infrastructure, stuff like that. I would like to point out something that I see cause a lot of confusion in the real world. And it's this. In accounting, as well as in finance, there are different ways to classify the same assets. So what I will do now, I want to basically simply have here a second way how that could be split. So my asset side starts only here. Let me show you that. Liabilities and owner's equity. So we are still looking at the same firm that has the same items, the same assets, but I just categorize now in a different way. So it is possible to classify assets based on their liquidity. How quickly will they be converted into cash? 1 year or less, more than 1 year. But you can also classify assets depending on what they are, based on their physical substance. So you could say there is a group of assets that are intangible. Intangible versus the rest of the assets that are tangible. I explain in a second. What does intangible and tangible mean? Intangible is simply complicated finance language for it's an asset that has no physical substance. It's an asset that you cannot touch. There are not that many examples for this. Licenses, copyrights, patents, trademarks, stuff like this. They would be referred to as intangible assets. And some assets are tangible, well, all the rest. Every asset that has a physical substance. A car is clearly something I can touch. Land is clearly something, I can literally walk on. Okay, so please don't be confused when you see assets grouped in a very different way. In finance, certainly for our course, this structure is more meaningful and more relevant. I just want that you understand that the same line items can be grouped in different ways. It's like you as a group of students, I could group you, based on your gender. But the same group of students, I can also group based on your hair color, or based on how much you can bench press, or based on your music likes. It's still the same group of students, it's just sorted into different categories according to different criteria. So this is not something that should confuse you or needs to confuse you. Guys, I promised after this we have a quick break. Is it alright for you if we have a break of about 10 minutes? Can you live with 10 minutes? Quick pee break, coffee smoke, boom, back in 10 minutes. Nice, guys. Super, I see you in 10 minutes in usual freshness. Oops. So guys, let's get back to work. So, guys, are we all back? Yes, nice. In the break, I just quickly had a look at the YouTube chat and I saw a question where I thought that's probably for me to address. What are we allowed to use on the exam? Which resources are you allowed to use on the exam? Open book exam, anything. Just what you're not allowed to use is your identical twin to do the exam for you. So the specific question in the chat that drew my attention was, can we use an Excel sheet? Yeah, you can. And if I were a student, I would show up with the most high-powered Excel sheet that you have ever seen. And if you don't, I mean, you don't. I mean, you can calculate everything with paper and pencil and the calculator on your phone. That will probably also work if you know your stuff. But why make it more difficult than it needs to be? In the real world, everything finance, everything accounting is an exercise in Excel. So yeah, that's the whole point why we want it online, so that it is as realistic, as real life relevant as can be. So yeah, make sure you have a high-powered Excel sheet. In the course of our course, I will every now and then point out certain things that I would do in an Excel sheet when the content, calls for it. And the second thing, I got a WhatsApp in the break that was super relevant. Thanks, Valentina, again. When you ask questions, I hear you really well, but people on YouTube don't, so I need to basically repeat your questions. Should I sometimes forget, please remind me, okay? Let's go back to our accounting stuff. Okay, so left side of the balance sheet, all the assets, so all the stuff that belongs to the company, that the company keeps with the idea of generating revenue in some way with it. And on the right side of the balance sheet, we see how all of this is financed. I'm simplifying, but only a bit now. They're broadly speaking two different sources of finance. It could be that the company has borrowed money, so that would be the block of liabilities. In finance, we don't really refer to them as liabilities, we refer to them as debt. It's of course the same thing still, debt. Or, when the money is not borrowed, it's the money that belongs to the company itself. So that would be owner's equity. The other day I got a question why I sometimes say owner's equity and why I sometimes say equity and what exactly the difference is. There is no difference. It's really the same thing. There is no other equity. Okay, so owner's equity, that's the same thing. So debt is money that we owe to somebody else that we have to pay back. And very similar to the asset side, we can also engage here in a much finer split. So I zoom in now a little bit. What we really do here is this. We have actually two kinds of liabilities or two kinds of debt. We have current liabilities and we have long-term debt. So it's a very similar split to the asset split that we have seen here. Current liabilities, take an educated guess what they are. The word current means less than a year. So that is money that we owe to somebody else that we have to pay back within 1 year or less. Tell me, who do we owe money to that we probably have to pay back in 1 year or less? So who most likely gets this? What do you think?
Creditors?
Yeah, creditors. But creditors, I mean, you're absolutely right. But creditors is exactly one of those words where we can easily use and then pretend we understand what's going on. And if we don't know what creditors are, yeah, so give me a specific example. Banks, for sure. Suppliers, exactly, that's what I wanted to hear. Banks is of course also correct, but the current assets, when we had the position account receivables, we said, well, that's most likely customers that owe money to us. So who do we most likely owe money to that we have to pay back on short term, in less than 1 year? Most likely our suppliers that are supplying raw material. Yeah, and of course long-term debt, so money that we have to pay back within more than 1 year. Okay, and then we have the block of equity. Equity is money that belongs to the company. It is not, technically it's not correct to say that's money that belongs to the shareholders. It's money that belongs to the firm. Who does the firm belong to? Well, the firm belongs to the shareholders. But you cannot, let's say you buy 1 stock of Apple, you could easily do this. That makes you a shareholder. You cannot show up then in the headquarters of Apple and say, well, hello, this is my 1 stock. I'm a shareholder. Show me the way to your cash register. I'm here to take some cash out. That is not possible. So shareholders provide equity to the company when they purchase shares in the IPO. So when a company sells stocks to the general public for the first time and you then buy one of the shares, one of the stocks, it's the same thing. You provide the equity and it belongs to the firm. Why would you do this? Why would you want to be a shareholder? There are a couple of disadvantages. You have no guarantee that you get your money back. You don't get any interest income. So it's not like you give a loan to the company. You equip the company with its own money and then you basically say, and now, roll with it, all the best, good luck. So why would a shareholder do this? A shareholder is an owner. A shareholder owns a part of the company. If you own 50% of the stocks of Apple, it means you own 50% of the company of Apple. And by extension, you also own 50% of all the future profits that Apple maybe, very likely, will make. So what's in it for a shareholder? Basically, shareholders get to enjoy the profit potential of the firm in the future. That's what's in it for the shareholders. Logically, that also means that shareholders are exposed to a much higher risk than creditors. If you're a bank and you give a loan to my company, you have essentially the legal guarantee that you will get the money back in one way or another. As a shareholder, you don't have that. If you buy shares of a company that performs every year very poorly, where there are never any profits, stock price will go down and you will never get a part of the profit. To sum up equity very quickly, how is it called when a company pays out parts of their profits to the shareholders? That's what we call dividends. And dividend policy is also something that in this course we will address at some point. Okay? So that's the broad logic, I would say, of a balance sheet. I would like to, before we move on, balance sheet wise, so far so clear? Any specific questions? Anything you remember from first year accounting where I said, well, I never really understood this? Anything we need to review? Very well. Let's hop into the income statement. Income statement, also known as profit or loss statement. I'm simplifying. We don't need it very fine-grained just yet. Income statement looks like this. The first position is called revenue, sometimes also referred to as sales. There is no difference. It's the same thing, okay? That is, brief sidebar, that is very common in finance. And I think that's the reason why, or the main reason why finance has a reputation for being difficult. It's very easy to get confused, or as a finance person, it's very easy to confuse other people. I can talk about revenue and in the next sentence I use the term sales. And as a listener, you think I'm talking about 2 different concepts, but it's the same thing. Or the term shares. I use the term share as a synonym for stock. It's the same thing. I always found it when I was studying myself very helpful to keep almost like a small, list of vocabulary just to track those different terms, okay? Whenever we encounter something like this, I will try to point it out. So it's the same thing. Minus expenses equals profit before tax. Let's talk about this for a second. So what is revenue? Well, we already addressed it a little bit. Revenue or sales is the money that a company generates through selling its inventory or through providing its service. Don't forget, not every company has a product. So for example, RSM, we are a school, we are a pure service provider. We do not have an inventory. So obviously our revenue is generated in a different way. We generate revenue by providing a service. And only that. You're only allowed to recognize as revenue when you sell your inventory or when you provide your service. You cannot say, well, actually we are a university, but we are such a shitty university. It's an example, that's not true. But let's say we are a very bad university, we treat our students very poorly, and after a couple of years of this practice, no students want to enroll anymore. So we have no revenue, but we have a beautiful campus. So let's say we sell off the T building. You are not allowed then to book the proceeds, the money that we get from selling the T building as revenue. That would be grossly misleading. Again, why? Because selling a building is not part of our operating activity, and to mix operating activity and just selling a building and make it look like that's from our normal operating activity, that would be considered grossly misleading, all right? Revenue sales minus, this is essentially a category. I wrote it down as one position. It's of course all kinds of different expenses. For the time being, that's accurate enough for our purpose now. Expenses means a company pays money and gets something. Now, going back to the balance sheet, what a company can do, they can take cash, so one of the current assets, and for that cash buy a car. So then cash goes down and the specific asset car would go up, would increase by exactly the same amount. The income statement is not affected at all. Why would I book it? Why would I record it in this way? Because the car is literally an asset that I have now available at my disposal for more than a year. If, however, we are a firm and let's say we rent our headquarters, the building, we have only rented, we have not bought it, we rent it only, then by paying the rent, I do not get ownership of the building. And remember, that's part of the definition of an asset, stuff that belongs to the company. When we pay our rent, we don't buy, we only rent. That means we get the permission to stay in that whatever apartment house for a month longer. So basically an expense means a firm pays for something, but no new asset is created. And why is no new asset created? Because whatever it is that you have paid for, you will use up, you will consume in much, much less than a year. Okay, so that are expenses. Brief sidebar, real life relevant. This is a manipulation you can see quite frequently in the real world. A company that wants to appear richer than they are might try to not record a payment as an expense. So let's say I have rented a car for 100. Then I would have to book the decrease in my cash in the balance sheet and the increase in the rent expense in my income statement. That would of course reduce my profit before tax. If I want to appear richer than I am, I could try, I would probably not get away with it, but I could try to book it differently. I could try to book it and make it appear as if I had bought a car. So then I would basically do this and book it simply in the balance sheet. Cash goes down, car goes up. That would of course be incorrect to the very least, possibly bring me to jail depending on the magnitude, but it would certainly be incorrect. And why would that help to create the impression of me being richer? Well, I don't recognize here the rent expense in my example of 100. That means my profit before tax would then appear to be higher by 100. All right, so that's how I could appear richer. You also can see in the real world the opposite. Companies that are actually doing very well already sometimes want to appear poorer. Why? Because of this here, because of taxes. So let's say I'm the accountant of a firm and I want to save taxes. It's illegal, all right? That's not something you should do, but you could encounter this, that we have truly bought a car for 100. The correct way to recognize it would be cash goes down and the asset car in the balance sheet goes up. but because I want to appear poorer to save taxes, I recognize the purchase price of the car as an expense here, even though I bought it. It's also incorrect. Then the profit before tax would obviously appear to be lower by 100 than it really is. And this position is very relevant. It's called profit before tax because based on this number, we calculate the corporate tax. So what would happen in the income statement after this would be minus whatever, 25% tax, corporate tax. And the result would be then profit after tax. Profit after tax, more commonly known as net income. So you see, the more expenses I pack in here, the lower my profit before tax, the lower my eventual tax burden, and through this I can maximize my net income. Of course, not legal. But that's why this matters if a transaction creates a new asset or if a transaction helps recording an expense. What is also very relevant, I already stressed this, is balance sheet and income statement do not exist independently of each other. And I want to quickly sketch this out so that you will never forget this, in case you don't already know it. Very quickly, we have the balance sheet, we have current assets, we have fixed assets. This here is, of course, our balance sheet total. It's just the sum of all of these. On the right side, we have liabilities and owner's equity. We have our current liabilities. We have our non-current liabilities. And we have our block of equity. And of course, I have here a balance sheet total as well. And both sides have to be equal. We have our income statement, revenue minus expenses equals profit before taxes minus corporate tax, TC, equals net income. What is the connection between those two statements? Let me show you. To the very least, we have two positions in the block equity. To the very least, common stock, and retained earnings. Retained earnings. Where do income statement and balance sheet communicate? Where do they link up? Let me show you. So the balance sheet is a statement that is prepared at a point in time, at the beginning of the year and at the end of the year. So at the beginning of the year, I prepare my balance sheet. During the year, I operate my business. I, of course, record transactions. I book revenue and expenses. So the income statement is not a statement that is prepared at a point in time. An income statement covers a period of time. And at the end of the year, I basically prepare my ending balance sheet. How do they link up? Like this. This is super relevant. This is super relevant now. The net income, if it's positive, if it's negative, a negative net income would be referred to as a loss. This is moved into the balance sheet. To be more specific, it's moved into the equity. And to be even more specific, it's moved into the position retained earnings. So it would go here. And that means if a company has a profit, then if the net income is a profit, then the equity would increase. If the company has a loss, the equity would decrease. All right? Is it clear what I'm saying? So what does this mean? When a company keeps generating profits after profits after profits after profits, you can see this in some way by the equity increasing. How does it increase? Specifically, the position retained earnings will keep increasing. And when a company at some point decides to declare a dividend, a cash dividend, meaning they pay out parts of the profits to the shareholders, they will pay it out straight out of the retained earnings. So after dividends are paid, you see that the retained earnings decrease in value, logically. If a company keeps making losses, that's what I have sketched out here in purple, keeps making losses, it's possible that the whole equity becomes negative. I don't want to talk about this in too great detail. If you would see a company with negative equity, the balance sheet looks very different. Then equity is not presented here anymore. Negative equity would be presented on top of the assets with a minus. Okay? No need to discuss this in great detail. That's very bad. If there's a firm with negative equity, I mean, don't work there, don't invest, you know, the usual disclaimer. Guys, is balance sheet clear, income statement clear, and how they are connected? If not, now is the time to speak up, and I'll do my best to explain.
There's one question about the last point. Is you said net income will be moved into retained earnings when it's positive.
Yeah.
Is it always the case that when the company pays out dividends, that part of the net income is first paid out as dividends, and then the rest of the net income is put into retained earnings? Or does it always happen after putting it into retained earnings?
Yeah, okay, so that's really, you're asking about the specific, sorry, let me repeat for everybody. The question was, what is actually the logical order of steps? Are sometimes dividends paid basically out of the net income, and whatever is left of the positive net income is then moved, or is the whole net income first moved into the retained earnings and then paid out? That would very likely be firm specific, but if you look at a textbook, if you want to read up on this, it would be called closing entries. Closing entries. That are the last journal entries a company performs before their financial statements are really finished and ready for publication. You would really see that the net income, just accounting, this is not even accounting anymore, this is bookkeeping. In a first step, the whole net income would be moved into the retained earnings, and in a last step, you take the dividends out of the retained earnings then. You do not book directly from here. But this is really not just outside of the finance scope, this is even outside of the accounting scope, because it's really actual bookkeeping, okay? But the sequence would be you recognize, you calculate your net income. Next step would be you move it into the retained earnings. Last step, you reduce the retained earnings by the amount of the dividends that you pay out. All right?
Okay, thank you.
Super. Let me keep an eye on the time. 22, perfect. And last but not least, let's briefly, more for the sake of completeness, look at the cash flow statement. That's also relevant. I think it is one of the most underutilized statements. There's a lot of information content in there. So let me show you. The income statement consists of 3 sections. They're almost like different chapters. 1, 2, 3. 1, 2, and 3. They have, of course, names. The first section is called operating cash flow. Operating cash flow. The second one is called investing cash flow. Investing cash flow. And the third one is called financing cash flow. I will really keep it brief, and I'm not going to confuse you with details. So there are really headings, okay? That are not positions, that are for now headings. And in each category, you only find 2 different kinds of entries. You find cash inflows and cash outflows. Cash inflows and cash outflows, cash inflows and cash outflows. That's it. But what is the logic here? So let's talk about the first one, operating cash flow first. This here, in this category, we are tracking all cash inflows and all cash outflows that occur as part of the normal operating activity. So to go back to my example, let's say Albert, I'm the manager, I'm a store manager at Albert Heijn. I have a company car. At some point, Albert Heijn decides that I will get a new company car, so the old one will be sold. The money, the cash that we earn from selling my old, or Albert Heijn's old company car, is a cash inflow. It's really cash because we put it on Marktplatz and somebody buys it and gives us cash. So it is undoubtedly a cash inflow. But it is not an operating cash flow. Why? Because a supermarket is not in the business of selling cars. Or, to say it more official, the cash inflow is not a direct result of Albert Heijn's operating activity. Okay? Where's my cash flow statement now? Let me see. Interesting. Okay, let me do this quickly again. Never mind. Cash flow operating, cash flow investing, cash flow financing. Inflows, outflows, inflows, outflows, inflows, outflows. So the first one tracks only inflows and outflows as a result from the operating activity. The second one, the investing cash flow, tracks changes in the fixed asset structure, only fixed assets. So cash inflows and cash outflows that have to do with fixed assets. So what would be the classic cash outflow here? Purchasing a new fixed asset, purchasing a new company car, purchasing a new building for a new store, something like that. That would be the textbook outflow. The textbook cash inflow in the category cash flow from investing activities would be we sell fixed assets. Okay? And last but not least, cash flow from financing activity. That is the cash flow that tracks cash inflows and outflows that are a direct result from anything happening on the right side of the balance sheet, so anything on the capital side. So, what would be a typical cash inflow from financing activity? We take out a new loan with our bank. That would be a cash inflow. Sure, later on we have to pay it back, no question about it. But initially when we say, hey, can we have a loan? It is first and foremost a cash inflow. If we want to talk about cash inflows that are the cause of something that has to do with equity, if we sell new stocks in the form of a seasoned public offering, then we would have a cash inflow because we sell new equity. Which cash outflow could we have that has to do with equity? Paying dividends. So what I can do then at the end of the year, I track all of this. And again, I have to stress this. This is tracking really only cash, okay? This revenue is not necessarily cash. You can, in the income statement, you can, of course, sell a product or provide a service and allow your customer to pay their bill later. Then it would be a credit sale. And it would not pop up here at all until the customer really has paid the bill. So this really only tracks actual cash that has been collected. So at the end of the year, what I will do is I will simply sum that up. So I sum up all my cash inflows and outflows from operating activity. And I will end up with something like cash flow from operating activity equals 200 euro. I do the same thing for cash flow from investing activities. Okay, I sum this up and I conclude the cash flow from investing activities is minus 400. And last but not least, I do the same thing for the cash flow from financing activities. So let's say this here is, I don't know, cash flow financing is 800. Okay? So I have now sort of my three cash flows, and what I can do then, I can sum up these as well. Plus 200 minus 400 is minus 200, minus 200 plus 800 is plus 600. So this here would be now the total cash flow. I don't want to, for now at least, it's really a refresher, so I don't want to dive too much into financial statement analysis yet. I want to stress how the statements are connected. So I don't want to comment too much, is this good or bad? It's for the time being not that relevant. I want to stress what's happening with the 600. Or to be more specific, I would like to ask you, very simple question. Is this number, the plus 600 in my example, the number that you find in the balance sheet next to the position cash at the end of the year? Tell me. What do you think?
No.
Dylan, why not? You sound very secure. I like it. Explain.
In this case, it's the addition to your current cash term in the balance sheet. So this is added to your cash and not the number itself.
Excellent, Dylan. Let me repeat for everybody. The correct answer is no, this is not the number you find in the balance sheet next to the position cash. What it is it is the change in cash. It is a delta. It is a difference. So how do you get then to your cash balance that you really see in the balance sheet? However much money the company had at the beginning of the year, so in the opening balance sheet on the 1st of January, plus minus this, and then whatever the result, that is the cash balance at the end of the year, all right? There's one exception. If a company at the beginning of the year had a cash balance in the balance sheet of exactly 0, then you would really find this number. Does this make sense what I'm saying, guys? Is it clear to everybody? Yeah? Let me see in the chat. Is the change in cash calculated at the end of the year? Yeah, the change in cash. So the question in the Zoom chat is the cash balance calculated at the end of the year? That's picturing it a little bit too easy. In the real world, of course, you book on all accounts all the time, also during the year. What is done at the end of the year? And this is, for this I have prepared. Let me see. I can finally use it. This is really interesting, but this is not relevant for I think the course. This is again really as grounded bookkeeping as it gets. So the cash balance, obviously you would know that during the year. What you do at the end of the year is you have to reconcile, that's really how it's called, you reconcile the cash flow statement with the income statement and with the balance sheet. So that means that basically the balance that you show for cash in your balance sheet needs to mathematically check out when you calculate it in this way, and all of this needs to be consistent with the income statement as well. So this is something that you see at the end of the fiscal year really going on in companies. The whole process is called year-end closing, when the company tries to get all the individual accounts into a condensed form, which is, well, the balance sheet, income statement, cash flow, and statement of changes in equity. So they say, we are now closing the accounts, the year-end closing has begun, and what we now need to do is reconcile the statements. And reconciling means to make sure that all the numbers in the balance sheet, income statement, and cash flow statement are checking out, that the math across all statement works. So that is the logic. That is called year-end closing, and this is how it would be done. It is not that a company, so Apple at the, let's say on the 31st of December, you should not imagine that then the top management of Apple gets together, everyone looks excitedly at the cash flow statement and says, oh my God, oh my God, oh my God, let's hope that we have a positive cash flow. So that would really be known firm internally, of course, for a while. All right. What else is relevant? That are the connections. So I want that you remember the balance sheet and the income statement are connected. I think the most important connection that helps us to balance the balance sheet is through the balance sheet position, more accurately through the equity position, and even more accurately, oopsie, wrong camera, sorry guys. Sorry. Income statement is connected to the balance sheet through equity, more specifically through the position retained earnings. And that means a profit, final line item in the income statement, increases equity, a loss decreases equity. And the balance sheet is connected to the cash flow statement. In what way? The total cash flow at the end of the year shows the increase or decrease, in my example it's an increase, of the balance sheet position cash. That's what it is. Okay, that are the most important connections. If you can follow with this, this is really something I need you to be quite proficient at. and that this becomes almost like second nature to you, then you will not probably struggle in finance, at least not because of accounting, I should maybe say. Okay? Am I missing something? Is there, guys, be honest with me, is there anything that is relevant that is intriguing, interesting, confusing from accounting? Anything goes. This is what I wanted to share with you today. I don't want to, it's our first lecture, I don't want to already say let's finish early. I was expecting you will drown me in questions, but you're not very vocal just yet, so there's plenty of time. Go crazy. If you have questions, please bring it. Because maybe I should give you some sort of incentive. If you ask me, let's say in week 4 of the course, hey dude, can you explain again what's retained earnings? I will react a little bit differently, because then you need to know it already, right? So now is the time to talk about that. Let me quickly have a look at the YouTube chat as well.
I have one question about accounting.
Shoot. Yes.
To what extent are we going to revise the ratios, or are they not going to come back in this year's course? All the ratios for liquidity and solvency.
Yeah, I mean,
those ratios.
yeah. Okay, so the question is, to what degree will financial ratios or financial statement analysis celebrate a comeback in this course? Is that going to be relevant, yes or no? I mean, so I will not ask you specifically about you need to calculate an inventory turnover in 2.5 minutes, otherwise it's a fail on the exam. Not in that way. So not like in first year finance, where this is really a specific learning objective. I would encourage you to review 2 categories of financial ratios. Dylan said already correctly, liquidity matters. And the second family of ratios I would like you to revisit would be profitability ratios, because finance is all about this trade-off between liquidity and profitability. So you will hear me use these terms quite a bit, and that this makes intuitive sense for you. I think you will save yourself quite a lot of effort, and you will get more out of the course if you revisit it. I have something that I want to share. That's perfect. That's perfect timing. I want to share with you 2 things. I want to show you what finance actually is about. I didn't want to start with it. I even made myself a small note. Don't forget this. The course is called Corporate Finance, and I have not explained to you what corporate finance is about, and none of you have asked me either. So it's a bit on all of us now. I want to show you what actually corporate finance deals with, because a lot of people think it's very abstract. It's not abstract, it's very concrete. There are very specific questions, and I can point with my finger at the questions. I need a balance sheet. We have assets, we have liabilities, we have owner's equity. We have, of course, our block of current assets. We have our block of non-current or fixed assets. We have our balance sheet total here. We have here our current liabilities. We have here our non-current liabilities, and we have here our block of equity. I want to share 2 things with you. They are not really related. I want to start with a sort of smaller thing first. I already know from WhatsApp, I know also I've seen it a little bit on Twitter, and just from conversations I have with some of you, that some of you are hardcore finance people and very much into trading. So if you're not, that's also perfectly fine, right? Not everybody has to become a finance aficionado, that's fine. But if you are one of those students who cannot wait to talk more about trading and crazy instruments, I want to point out something here that might be interesting to you and offer sort of extend the offer that we can chat in a separate setting about this. I have actually simplified here quite a bit. It's not relevant for our course really, but it's relevant for the real world. Look at this. So current liabilities and non-current liabilities together in finance are referred to as debt. And this here is of course equity. Okay, nothing new. And I said before, a company can choose how they want to finance their beautiful assets. Either they borrow money or they use their own money, equity. But that is a gross simplification. There is actually something else that I have not pointed out, and it very rarely shows up in textbooks. It never shows up in diagrams like this, never. And that's something in between. In the real world, it's true that most companies use debt and equity for financing their assets, but that is not all that is available. There is more. There is a very interesting group of financial instruments that is actually logically in between debt and equity. This group is called hybrid. Hybrid financial instruments. They are called hybrids because they have characteristics of debt as well as of equity. So there are instruments where you cannot look at them and say, oh yeah, that's clearly money that has to be paid back, so it's debt. And it's also not clear that you can say it's equity, it's something in between. It's either neither of them or it's both of them. And I just want to give you one example. One example for a hybrid would be the so-called convertible bond. Then the reason why I bring this up, first of all, sometimes trading interested students ask about this. What about hybrids? Are we going to discuss hybrids? Hybrid instruments are considered very challenging to understand. That is something, if you're interested in that kind of stuff, then I happily meet up on campus with you for a couple of beers and we talk then about the master finance and investments, because that's where you would encounter this. However, if in the context of our course you want to chat a bit about hybrids, specifically convertibles with me, you can, because that's my research field. So I don't want to claim that I'm an expert on it, but I'm in the process of publishing one paper on the on the origin of convertible bonds in the Netherlands just now. So I quite like talking about it. And if you say, hey, you want to talk more about convertibles and trading and stuff like that, I mean, you can always text me and I happily come to campus for a couple of beers and just chatting about this. That's the first thing I wanted to share. And the second thing, and that's really relevant now for everybody, I said, and it's a nice way to end today's session, I can point now out what corporate finance is really about. So you could say corporate finance concerns itself with one big objective, and that is maximizing the value of the firm. What does that mean in normal human language, to maximize the value of a firm? To maximize the value of all of this. That's what it means. As I'm saying it aloud, I realize I have to acknowledge that's a non-explanation. So what does that mean? So the big question, how can you maximize the value of a firm, needs to be broken down into two other questions. And that is what corporate finance is about. Two questions. Question number one, in which assets should I invest basically my funds? Or in more simple language even, which assets should we get? That's corporate finance question number one. That is something that should not be new to you. That is largely what you have addressed in your first year course. That is the reason why we need net present value analysis. Should I engage in this project, yes or no? Should I open a new shop, yes or no? Do a net present value calculation. If it's positive, yes. If no, no. So question number one in corporate finance, in which assets should we invest? And question number two, and that's what this course is about, the first half. I said before, as if that is an explanation, oh yeah, we're going to talk half of the course about capital structure theory. What's capital structure theory? That's addressing the second question. How should I finance my assets? That are the two questions. Corporate finance concerns itself with one question, how to maximize the value of all of this. This is a question you cannot answer in one go, because it breaks down, it falls apart into two sub-questions. Number one, which assets should we invest in? And number two, how should we finance these assets? And our specific course will, half of it, address this question. How should we finance our assets? So that's really what corporate finance is about. Guys, this is really it from my side for the day. Is there anything, any question I can answer, anything I can do for you, anything we need to address before we call it? Let me quickly, I always need to step away from the camera because of the YouTube chat. Let me just have a quick look. I hear you still, so if you want to say something. Income statement changes, balance sheet. I see a question from Emil. The income in the YouTube chat. The income statement changes the equity on the liability side of the balance sheet, but what would then change on the left side to keep the balance sheet in balance? Yeah, this is a cool question. Let's quickly do it. I can show you. We just do a specific example from scratch. Very quick. Oh, it's purple. I want black. Give me a second. Let's say you and me together, we want to come up with our own company. So we start by creating a balance sheet. We have a cool business idea, but we create a balance sheet. This is really how it would look. We have no assets, we have no liabilities and no equity. We have nothing. And then we say we want to operate our company. So what we want to do is we want to be a lawn mowing company. So that means people can hire us and we show up in their garden and mow the lawn. So we need stuff to operate our business. I mean, we're not gonna, cut the lawn with scissors. So what we need a lawnmower for this. So we look up online on ball.com, lawnmower 100 euro. Perfect. So we need to raise somehow 100 euros so that we can buy the lawnmower, which we need to run our business. We are not a publicly listed firm, so basically this is not really available. We will take a loan. So we get a bank loan of 100 euro. In what form does it exist in our firm? Well, immediately in the form of cash. 100. Balance sheet is balanced. But we didn't get the loan so that we can have 100 euro. We need the 100 euro to buy the lawnmower. And that is, of course, the next step. So we take the cash, whoop, it drops to 0, and we buy now the lawnmower. And the lawnmower, and it shows up with 100. You see, I'm still balanced here. 100 and 100 here. And now we are actually ready to operate our business. Now we can really offer lawn mowing services to customers. And that's what we do. So then we need our income statement, revenue minus expenses equals, I'm simplifying now a little bit, profit or loss, just to wrap it up, but answer the question. So then a customer approaches us and says, hey guys, can you mow my lawn? And we say, yeah, sure, of course, 10 euro. So that is our service. We are not selling a product, we provide a service, the service of mowing lawns. We do this, and after we have mowed the lawn expertly, we collect 10 euro from our customer. So the customer gives us 10 euro cash. First of all, have we generated revenue, yes or no? Well, we are a lawn mowing company and somebody just gave us 10 euro because we mowed their lawn. That is textbook revenue. So I book revenue 10 euro. What else will happen? Well, our customer gave us cash. So I need to, of course, record that. If somebody gives me cash, I have it in the cash register. So our cash balance changes now. And we have now cash, how much? 10. The 100 that we borrowed initially has gone because we bought the lawnmower, but we have now, of course, the 10. Our revenue came in the form of cash. We did not say, hey, we mow the lawn and then you pay us later. We said, yeah, cash. So what has happened now? I have now a different balance sheet total here. 10 plus 100 is 110. And that is what Emil's question is about. How do you balance this now? And that is why I stressed the importance of the connection between balance sheet and income statement so much. How do I balance this? The year is over. Let's say no other transactions occur, just to keep it simple, and we close our accounts. So let's look at our income statement. No expenses. So how much profit or loss did we make? Plus 10. Nothing else has happened. Where does the profit or loss go at the end of the year? That's why I obsessed over it so much. This year, at the end of the fiscal year, at the end of the business year, is transferred into the equity, to be more specific, into the position retained earnings. Boom, retained earnings. There it is. How much? 10. 100 plus 10 is 110. Ta-da! This is how that works. Emil, would you say your question is answered? Is it answered? Any other questions? Anything you need at this point? All right, guys. Then let's stop here. Closing words. I mean, I'm super happy this goes well. I'm super relieved that everything technically seems to work. I have to admit I could not sleep all night because I was so worried if everything will work as I wanted it to work, and I can only test with students when students are available. I'm really relieved. Like I said, please don't worry about WhatsApp groups. I will organize probably a Discord where we can all participate, where we basically can talk to each other in a neat way, not on Canvas, ideally. And in the course of today, we will make our Canvas structure neat and tidy and user-friendly. That means all the modules, the course manual, all the stuff, and of course, the appropriate links. Okay, so just give it a day. This will all be available. Guys, thank you very much for your attention. I really appreciate it that on a Monday, on short notice, you made it out of bed to join me to talk about accounting. That's very promising. In our next lecture, we will go through first year content, like I said, net present value, WACC and CAPM, and again, emphasizing the connections between them, okay? So if you want to prepare for that, you don't need to read up. I just would like it if you could write down what was unclear, where you struggled the difficulties, so that we can have a very streamlined session where I can add most value. This is it. I'm not going to say anything more. Guys, have a great day. And I see you, what is it? I think on Wednesday is our next class. Have an awesome day, and I see you soon.
All right, thanks.
See you guys. Doei doei.